welcome to another episode of Classroom. Part of what Classroom is about is understanding how to become a smarter investor, understanding the tools that you should employ, and understanding what makes the market tick. But perhaps part of it is also understanding how to route that interest in the market and which instrument makes most sense for a particular investor versus the other. So today we're talking about ULIPs, unit-linked insurance plans. What makes them tick? What are they all about? How are they different from any other instrument? Two gentlemen who understand that subject very carefully join in to talk about it. Puneet Nanda, Executive Vice President of ICICI Prudential Life Insurance, and Kamesh Goyal, MD and CEO of Bajaj Allianz Life. Gentlemen, great to have both of you on the show. Classroom is all about definitions. So Puneet, you go first. How would you define a ULIP?
ULIP, as the name suggests, is a unit-linked insurance plan. It is a flexible instrument which allows the consumer to combine the desired objectives of life insurance, perhaps health rider and investment in one single convenient instrument. And because of the nature of the instrument, all the elements can be transparent and actually can be dealt with separately, which is why there is a lot of flexibility that is available. And over the life cycle of the product, and the product could be a 20, 30, 40 year kind of product, consumers will have the flexibility to change the requirement on each of these three elements.
Kamesh, that's the definition of it. If you had to define the need for it, what would you say is the need in the market for a unit-linked insurance plan?
Typically, when you look at life insurance business really started when people wanted to protect their families in case something happens to them. And then over a period of time, the life insurance product evolved towards aspirational goal that somebody wants a certain amount of money because the child would be at a certain age and they wanted to take care of the education of the child, or somebody wants to get the child married, or somebody wants to save some money for retirement. So basically, this product is all about achieving the goal with the possibility that a person is alive and continues to pay premium, or the possibility in that unfortunate circumstances that the person is not there at all, that those aspirational goals are still met. So when we look at unit-linked insurance plans, we should also keep in mind that they come with large number of what we call as riders, or the options where, say, things like a child rider or a health rider, that irrespective of a person falling critically ill or if a person dying, those aspirational goals are also met. And as Puneet rightly explained, that the investment component of these plans, which is very transparent, can also be chosen as per the risk appetite of the customer, and this could vary from time to time. So today he could be in equity, tomorrow he could be in balance fund, the day after he could actually be in a pure fixed income kind of a fund. So all these things basically will lead to a situation where a customer would definitely achieve his aspiration of the objective with which he started saving the money for the future.
So Kamesh, is there one specific vanilla road that a ULIP has to go down, or can it be of different shapes and forms? Can it be a diversified equity? Can it be a fixed income if it so chooses?
Definitely. In fact, the choice is a lot more wider. And let me just very briefly explain on this. The first is that whenever a person is choosing to buy a ULIP, they should use the term of the policy which they are choosing very carefully. So if you are buying a ULIP when you feel that your requirements will come up at the end of 20th year, you should choose a term which is 20 years. But if you feel it will come at the end of 10 years, then you should choose a term of 10 years. And once you have chosen a particular term carefully, then you should ensure that you are paying the renewal premiums at all times. So I think that is one very important element. The second is you can decide to pay premium on a regular basis each year, or you pay one-time premium, which is single premium. That you are not really sure whether you would want to pay premium each year, you can opt for a single premium policy. So I think that's the second. And third is that the investment options in ULIPs are absolutely diverse. You could have large equity, you could have mid-cap equity, you could have an index fund, As I said, you could have a balanced fund. You have NAV guaranteed products now available in the market by lots of insurance companies. Then you have fixed income. You could have a guaranteed fund that, okay, if you are invested with us for 10 years, you will get in single premium products, quite popular to give a guarantee for each year. So the choice which is available is really, really large.
Puneet,